Welcome, everybody, to the Retirement Success in Maine podcast. My name is Ben Smith. I'm joined by my Ben Bernanke to my Janet Yellen, Curtis Wister. How are you doing today, Curtis?
I'm doing well, Ben. How are you?
Good. Well, for those that are not up on the Fed Reserve Bank chairs from previous years, a couple of those during the last decade. But right. We of course are recording here in early May. And a few things we've been, of course, receiving from clients and a lot of concern around things, because I know with our show we've covered lots of different topics. Actually, the next show, we're going to get into Medicare a little bit. We're turning 65. So when you turn 65, you become eligible for Medicare. So we're going to do a podcast on that.
It's true.
But before we get to that, we got to start worrying about shoring up our portfolios and thinking about things that are kind of keeping our cost of living intact. And one of those things that I think is the topic that's happening a lot is inflation.
Right.
So inflation is, I think, where a topic where we just want to understand a little bit more and kind of in a few ways. One is we obviously are seeing it from, being in Maine and in the Northeast, where our heating oil has gone crazy. We've been putting more money into our pumps, into our homes to keep it warm, but also from just everyday living, going out to eat or groceries.
Sure.
So if I retire and I thought I had so much money that I was going to live on, and all of a sudden my costs become higher, what should I be doing to kind of shore up my financial plan, my portfolio? What are some things I should be thinking about? So we wanted to understand inflation a little bit better. Was the topic we wanted to cover today. Was really about combating inflation that might be impacting your retirement. So our next guest is actually an investment consultant with our team, Guidance Point Advisors. Right. So over his 27 years in the financial services industry, he's provided capital market expertise to some of the world's largest money management institutions. Prior to Guidance Point Advisors, he began his career at Goldman Sachs, initially as a fixed income research liaison, analyzing portfolios, optimizing security selection, calculating option valuations, and going back to school, that T-graphs, just when you say calculated option valuations, man, and constructing relative value trading strategies. He advanced to become a vice president as securitized product salesman, covering large institutions with assets under management up to $2 trillion. His clients comprise of mutual fund managers, separate account managers, insurance companies, hedge funds, banks, sovereign wealth funds, REITs, and pension funds. Over the course of his career, he's transacted in multiple types of fixed income securities, securitized, U.S. treasuries, agencies, corporates, and municipals. He's spent 15 years at Goldman Sachs, 6 years as a director at Deutsche Bank, and 6 years as a managing director at Nomura Securities. He lives in Wellesley, Mass. with his wife, Leslie, and 3 children. So at this time, love to welcome our colleague, Chris Del Cole, to the Retirement Success in Maine podcast. Welcome, Chris.
Well, thank you, Ben and Curtis. It's great to be here. And looking forward to talking about a hot topic of inflation.
That's right. So Chris, I'm sure, as you know, with our show, obviously we have kind of that key topic of inflation to talk about today. But to start, we just want to kind of take a minute and really introduce you to our audience. So obviously, Ben just read off your very in-depth background there. So could you just take a minute and just kind of talk about your career and your path towards working here at Guidance Point?
Sure. I know you guys always like to say, what's your connection to Maine? And I attended college in Lewiston, Maine, Bates College.
All right.
And I was a math major at Bates College, and then found my way to Goldman Sachs. I'm a people person and wanted to get into sales. Didn't know that opportunity existed on Wall Street. This is dating myself back in 1988. But I was fortunate enough to get a job in sales and trading within the fixed income department at Goldman Sachs way back when, and had a nice long career on Wall Street, selling mortgage-backed securities primarily during my time.
Well, hey, Chris, I'd love to hear a little bit about again your childhood experience, right? So, kind of building up to going to school in Maine here a little bit, but also what was the interest about again, kind of the numbers into math into investments? What was it about here? Here you are, a people person, but of course we have the quantitative side, the other side of the brain, kind of leading you towards that. So, how is that what was that thread for you there?
Yeah, it's interesting the way life takes you down certain paths. I had a proclivity for math and numbers, and it is what I pursued at Bates, as I said, and it Wall Street fascinated me. I think that it's a numbers game, but it's capital markets, developing financing for the growth of all different parts of the economy and businesses. I have to say, I often say to anyone who's in college, it's very hard to know what it means to actually work at a job. But there was something about it that intrigued me. From the first day I sat on a trading desk, which is an exciting part of Wall Street, in the days when it was lots of shouting, lots of activity, and you had to react to things that were happening in the market, react to your clients' needs, react to what the traders were trying to get done. It was all fitting with who I was as a person. And so I really enjoyed that. And looked back and said, great, I'm glad I chose sales and trading over other paths that I could have taken, like investment banking.
That's really great. So fast forward to today, obviously you're working here at Guidance Point Advisors. Can you just talk about, what you like most about working here?
Going back to my statement of saying I'm a people person, being in the private wealth management space, there are lots of different groups that work in private wealth management, sure. And I like the nature of the fact that Guidance Point Advisors is a small group that works very closely with their clients. We're not buried in a large organization with a lot of bureaucracy. And it's a terrific group of people, and that's important to me. And so we work closely with our clients and have direct dialogue, frequent dialogue, and that's really what I like the most about Guidance Point Advisors.
Well, I think that's well said. And I think it's one thing to really enjoy working with the clients that we all work for, but to kind of enjoy working with the people that we do on a daily basis too, it kind of adds that layer of, I think a lot of people in their corporate careers don't get that a lot. So I think I think we're all very, going back to what we heard a couple episodes ago about being grateful and having gratitude. I'm personally very grateful for that been in a few spots is you don't always get to choose who you work with in your life and how you spend your time. And I think we've all been very blessed and lucky to have a really good, dedicated, well-educated, caring group of individuals that we all can kind of help our clients with. So, but I want to switch to the topic about inflation. So I think the first part is we always like to just start off with, let's build the foundation of the topic. And one thing I want to just read off, so the definition of inflation, this is coming from Investopedia. So I want to bake that into the conversation right out the gate. So looking at the definition of inflation, it's defined as the decline of purchasing power of a given currency over time. A quantitative estimate, I'm sorry about the words here, quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. The rise in the general level of prices, often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. So kind of going to that basket, right? Is looking at the government looks at, well, what do people buy on a daily or weekly or monthly basis? So whether it be bread and eggs and milk and oil and kind of all gasoline, all those things, and kind of say, well, this is the basket of things that people typically buy. And then what's the change in price from point A to point B, to just kind of put that simply as a definition. So Chris, my first question for you here is, what do you think the larger impacts are of inflation on our lives and our financial assets?
Well, it's a great question, because I think that people on a daily basis, when I'm talking amongst clients and friends lately, what is the first thing that they mention when they talk about inflation? It's the price of gas. Mm-hmm. And it depends on where you are on the income stream, but the price of gas can have a large percentage impact on your disposable income, or less so. But the most important thing is that we drive around our communities and we see the price of gas, and we'll notice that it's $4.25 yesterday and $4.35 today, and who knows where it's going to be tomorrow. And like you said, with the definition, inflation is a basket of goods. So I think that hitting us in our on a daily basis is the price of gas, yet it might not be as important to our lifestyle or impacting our lifestyle. I think probably one of the biggest spends in our lives are rents or our mortgage, right? Mm-hmm. And that cost of living is, if there's a rise there on that component of inflation, it's going to probably be the most impactful on our own personal balance sheet. Again, we don't go to the grocery store on a daily basis to know what the price of milk is, or we don't go to a restaurant to know that the price of the food that we're eating is changing. I think that the most impactful on our probably lifestyle is rental income or mortgage payments, and that'll get into kind of how interest rates and so forth.
Mm-hmm. Yeah, so I like that, Chris. And, obviously Ben just kind of laid out there or read out that definition of inflation for us. So naturally thinking of this, the opposite direction, right? So the opposite of inflation would be deflation, which I think people hearing that would say, oh, it's the opposite. Wouldn't that be a good thing? Doesn't that mean prices are declining, right? Making things less expensive if inflation is leading to things being more expensive. So can you just kind of expand on that maybe? And, is it really a good thing do we want deflation or inflation, or what's going on here?
Right. Without going deep into kind of what a central bank tries to achieve, which an ideal level of inflation is a slight positive level of inflation over time. Okay. And we'll get into, because too much inflation makes things too expensive, and you need to spend money early, or you need to spend money today because it's going to be worth less tomorrow. Right. And the contra of that is deflation, where you're going to choose not to purchase things, or you're going to save today because something is going to be less expensive tomorrow. And those two forces you're trying to balance out and get to be at a more moderate level. You don't want too much, you don't want too little. And so to answer your question of specifically deflation, no, you don't want too much deflation, because it would force people not to spend. Therefore, it won't drive the economy. We won't end up with a positive growth to the economy, or a positive GDP, which is the goal that we're looking for, to sustain employment and full employment.
And so, Chris, and I think that's a really great definition too, because he said it's like, so one is we slow the economy so much that again, prices start falling, but then prices fall, and then essentially the economy doesn't grow at all. So then we could have economic collapse, because everybody just stops spending altogether, because everything's always going to be cheaper the next day and the next day and the next day. And then you have inflation. And actually in our Bangor office, we actually have a framed kind of story. It's actually of Zimbabwe currency, and it was in 2007, I think, is the first $1. So it actually just follows the denomination of the Zimbabwe currency as basically they go through hyperinflation, right? So hyperinflation, I think, is anything over 10%, right? Is over that. So Zimbabwe privatized their land, and they allow everybody to now get their own crops and farm their own property, which many of them are not equipped to do, and the economy collapses. Right. So the economy's collapsing, and as that's happening, inflation is just going rampant. And I think at one point in 1 month, there was like over 1 billion% inflation happening from 2007 to 2008. So essentially, they started making larger and larger denominated bills. Mm-hmm. So they get to in I think 1 year later, they got to a $1 trillion bill.
I think it's even higher than that. Now you're making me want to get up and go check in our conference room. I think it's like 100 trillion. We have a printed $100 trillion bill. Yeah.
So it is the largest denominated bill in human history. But it essentially, if you look back to the previous 1 year, it was equivalent to the previous year's like $2.20. Yeah. So they overinflated their currency so much that it completely devalued it, and it took a whole lot more of their Zimbabwe dollars to buy what was originally just $1 the year before. So they just kept printing. And again, as soon as they printed the dollar, it was devalued so much that they had to make it even more denominated. So they eventually just went away from their currency and just embraced euros and US dollars as their currency. So I bring up that example because I think these conversations come up with our clients about, hey, I heard inflation is 4% or 5% and all that. And what's a bad level of inflation? What's a bad level of, say, deflation, and what's good? So I guess my question, long-winded question to you, Chris, here is: so what do you find are the pros and cons here of inflation now that we've kind of established deflation and inflation?
The pros and cons of inflation, like we said, if inflation is maintained at a reasonable level. And we'll say that a reasonable level, the central bank, Federal Reserve, has kind of looked at the 2% level of positive inflation as being the optimal inflation point. And their mandate is to get the economy to be centered around 2%. And with it, you would have a resulting GDP, a positive GDP growth. So the economy is growing. People are being employed. The unemployment rate, presently is 3% or so. And so you're looking to try to have a growing economy where assets will appreciate over time, and yet they won't appreciate uncontrollably, where you'll have to earn that much more to purchase those assets down the road, because there's a separation too, where the price of goods could rise at one point and your wages won't necessarily keep up with inflation. So kind of said another way. So if you're kind of saying, hey, well, the Fed Reserve Bank, which is, one of our kind of core institutions of kind of keeping an eye on our money policy and kind of where our economy is, if they're saying, hey, say a 2% is their target of inflation. So they're essentially looking at using tools, right, to kind of keep that 2%. So if we get out of bounds a little bit, we're going in the breakdown lane, that they want to kind of steer the economy back in towards that 2% target. Like right now we're hearing 7 and 8% inflation numbers, right? Kind of in that range. So they want to do something that then causes inflation to get lower, to get closer to 2. And if they did too much, right? So if they go from 2% down to 1 to 0 to negative 1% inflation, closer to deflation, they would do something to speed the economy back up in a way, or try to implement more forces to stabilize inflation, right? Is essentially what the role is. And as you kind of described,
I think from our end as advisors, right, is to help, well, looking at matching what costs are, which we don't have control over, right? We don't control what the prices are, but we can have a little bit more influence maybe over if folks are retired or they have savings, is trying to keep your savings and long-term money to keep up with inflation as well, right? So that's, I think, from our job is keeping an eye on both together. What's your lifestyle to what is the income, and I think neutralizing inflation wherever we can long-term.
Yeah.
Right.
Because there's the discussion of what is the proper real rate you should earn on your investment. And so that people understand it, a real rate is if you have a long-term bond that is at earning you 4%, and inflation over that long-term holding period is 2%, your real return that you've earned is 2%. That is 2% inflation is eating away at your buying power each year and you're earning 4%. So you're earning a positive real rate of return. And we've had an interesting environment for the last several years as interest rates have been so low that we have been at a negative real return on investments in the fixed income space.
Mm-hmm. Gotcha. So I have another question for you, Chris, here. And I just want to ask, how does the supply of money impact inflation?
So inflation, the way to look at inflation is it's going to come from two factors, two prevailing factors. Supply of money. So if there's an inordinate amount of money chasing a certain amount of goods, you are going to get inflation. Mm-hmm. And what that means is if a lot of people have more money than they did yesterday, they're going to attempt to spend that money for the fixed amount of goods that are out there, and it's going to result in higher prices on those goods or inflation. And inflation could also come not necessarily from more money being printed, but you can have a situation where the goods that are being supplied to the economy are disrupted all of a sudden. And that was what we witnessed with COVID. Okay. All of a sudden, because of supply chain disruption, employment disruption, the amount of goods that were normally supplied to the economy prior to COVID were disrupted. And so the same amount of money was chasing less goods, and therefore it was resulting in higher prices as well. Now, because of what the United States government did and pumped in more money to make sure that people had food on the table and survived during COVID, because we didn't know what the situation was going to be, you had a combination of both, a supply side disruption of the goods and more money into the system. And that's why we're at 7.5% inflation at the moment.
And it's also if I'm, so again, kind of as you're describing, Chris, this whole like the Fed's trying to keep the inflation number and the economy growing and employment in a positive, right? So that, again, they're trying to keep it kind of, use the golf analogy, down the center of the fairway, or kind of right in our lane, right? They don't want to go out of bounds and get on the breakdown lane. And so they really want to keep it in this. So you're kind of talking about the tools that they have to kind of keep it there. So I guess this kind of supply part is, it's interesting from they're making moves and we don't know how the economy is doing maybe until after the fact, right? We don't know how the economy grew from January 1st until March 31st, maybe well into May or June, or maybe even 6 months later when we get the data on how everything actually, so we have estimates in real data in real time. So the Fed's kind of looking ahead and saying, hey, if I make this move in 6 to 12 months, what do I think it's going to be at that point? So they make moves that it take a while to go through the economy to kind of get there to see if inflation, so it's tough when what I'm trying to say is what you described as supply chain issues plus money supply of getting the economy back on track after this pandemic, people being out of work, they pumped all this money in. Now we have all this supply, but now maybe we did too much in the time it worked through. Now maybe we did too much. We have to now ease and kind of get back off of that. So it feels like a really tough thing for the Fed, right? It's a very tightrope act. They don't know what it's going to be 12 months from now, and they can just make a decision what they think it's going to be. And meanwhile, I think that's what's tough from a being in it in the near term. We're seeing our lives impacted from interest rates move up in bonds, stocks wondering what the Fed's going to do, and is that going to cause recession? I know we're going to get into that a little bit, but I think those are the Fed and us maybe have different timelines of how we're reacting to kind of the day's news.
Well, I think that's a great point, and not only do we have a different timeline than the Fed in terms of our reaction, but the markets have a different timeline than the Fed in terms of the reaction. And you bring up a great point of the pricing of goods. It takes time to work through the system, and so the actions from the Fed are not necessarily going to impact things tomorrow. When we're driving by the gas station and seeing $4.50 a gallon. It's going to take place down the road, and yet the stock market might be anticipating that already down the road and pricing in what is 12 months from now or 2 years from now.
And I guess I'll add, Chris, is it's sometimes hard too, because I think what we see as the most recent data. So, for example, like we're seeing inflation at 7 or 8%. It's easy to then go, hey, if I'm retiring today and I see 7 or 8% inflation, it's very natural, I think, for us to then put that in our minds and go, well, it's 7 or 8% inflation. And that means for the next 30 years, I'm going to be experiencing 7 or 8 inflation as the number. So all of a sudden, we then put that pressure on ourselves of, well, we have to do lots of different things to keep up with a 7 or 8% rising costs of our lifetime. And I think what you just described is the Fed's trying to figure out, is half of this supply chain issues where oil is maybe disrupted from Russia and Ukraine and kind of the geopolitical crisis there and all the supply chain issues we've had where people are getting sick as they're trying to deliver things across the Atlantic or Pacific. Is that what's causing a lot of this? Or is it, hey, we just issued a lot of money and stimulus money to people. We're all feeling wealthier. And are we using all that money all at once? And to your point about chasing all the goods all at once, is that something that maybe was the monetary side? So we don't know the combination, but when we look at long-term kind of what we think inflation is, I think that's some of the reaction I'm hearing from the clients today is I think that all of it's just, it's really permanent inflation. And this is something I need to react to today. So is that something where, I guess, what are you kind of hearing from your clients and what are you telling them when they kind of bring that point up?
It's the discussion on that, not reacting to what is in the news today is a common thing. I don't know if you guys ran into this, but I do vividly recall in the spring of 2020 when the equity market had rebounded and all my clients were saying, why is the equity market doing so well when the world is completely shut down? And the equity market was pricing in after the pandemic. And when it was going to come, who knew? But it was, it had already fallen dramatically up until March. But everyone was scratching their head saying, why is the equity market doing so well? Unemployment was rising at that time. We weren't talking about inflation. It would be probably deflation. But it was looking down the road. So I think that it's always important to try to look long-term. In general, our clients are long-term investors, and we remind them, if something hasn't changed, we're planning your money for a 15-year, 20-year stretch of time. And we will make adjustments today that are really going to impact things over 15, 20 years, not what are going to affect things in the next 6 months.
And I think that's a good point because in today, I know this is a podcast we're trying to kind of illustrate long-term thinking and where we're trying to go in retirement. But one of the things that, just kind of using an example of a headline today, Market Watch, top of the page, and of course they do it in full caps, like 40-point fonts, and it's yelling at you. It says Bill Dudley, the former president of the New York Federal Reserve Bank, says it's very, very unlikely that the Fed can tame inflation without sparking recession. And Bill Dudley was the former New York Fed chief. Yeah. So you get this, oh no, this is terrible. But I think what, Chris, to your point of, right, so when you hear that sort of headline, right, this has got to mean something to where I think where we're looking at that might mean something to us, where if I'm, I don't know what this means at all, but this sounds terrible, right? We're going to go into, it's very, very unlikely, and he has to say it twice, that they can't tame inflation and without sparking recession. So what do you kind of take from that headline, Chris? And what does it kind of mean to you in terms of what you just said, especially about long-term thinking?
Yeah, well, CNBC loves to live off of hyperbole, right? And so they're going to go find that one economist or former Federal Reserve official that says very, very, and that's going to sell eyeballs, or I don't know what the term is. It's going to attract eyeballs. The reaction to that, though, is I think Bill Dudley is just expressing the difficulty that Chairman Powell has right now. A lot of people like to say it's an aircraft carrier. The U.S. economy, multi-trillion-dollar economy, is it's just, he's got an extremely difficult task ahead of him to try to, as we said, predict what's going to happen 6 months from now. How much is the money that was put into the system versus the supply chain issues to turn the ship? And he has done a fantastic job of telegraphing what his intentions are. And why does he do that? He telegraphs his intentions because at the end of the day, interest rates that he is trying to control are really what he's trying to control is what the market participants of the bond market are going to price into the market. Everyone thinks that they just set a lever and interest rates then follow that. All they're controlling are the front end of the yield curve, the Fed funds rate. What's really important to the borrowing out there, and not to get into it too deep, is what the longer term interest rates are. And longer term interest rates, 10-year tipped around 3%. That is going to control the borrowing for the entire economy, whether it's consumer or business related borrowing, that would slow things down. And basically that's what they're trying to do. They're trying to slow things down, the demand side of things, so that inflation comes more under control. Will it tip it into a recession? Going back to what Bill did, it could. Is it the end of the world? Is it going to tip it into a long sustained recession? Highly unlikely, because they will use their tools if in the event they see it as becoming a long sustained recession to try to bring things back and get back to that equilibrium level of a 2% inflation target that they're trying to get long term. So it's a slow moving process.
No, that was a great kind of excerpt there from you and kind of reaction there. I want to so we've talked about obviously how we all kind of manage our clients' money for the long term, and we try to, what we're doing may not affect the next 6 months per se. But I want to kind of focus on right now, and obviously here in early 2022. I just want to ask you, Chris, how has inflation been impacting stocks and bonds kind of right now? What are you seeing?
Well, I think that the important thing to understand about the equity market and the impact of the equity market, impact of inflation on the equity market, is inflation brings upon monetary policy by the Fed that has to change interest rates to try to draw down that demand side of the equation. The equity market values the companies that make up the S&P 500 based on that long-term rate that we talk about, the 10-year rate. There's earnings from company, and they're projected out over time, 5 years, 10 years forward. And the equity analysts that help determine where people are going to buy stocks and sell stocks, they use the rate on the 10-year for valuing those companies. And if higher rates come, those values have to come down. It is the simple math of discounting the cash flows, those 5-10-year cash flows forward, they have to come down. And that's part of the equation of bringing, the Fed isn't trying to reduce asset prices. They're trying to reduce the demand side of things, but a corresponding reaction of higher rates is going to be lower equity valuations. And have we lowered them enough at this point for a 3% 10-year? We don't know. It could be, maybe we settle in at a 4% 10-year. We don't know, and it might imply, or maybe the equity market's already pricing in a 4% 10-year. We don't know. But equities are being, equity valuations are being determined a lot to do with what interest rates are doing in terms of the movement. What is happening with bonds? Bonds are going from where they were at 1.5% on 10 years to 3%. And not to get mathematical, but that's duration. Yields rise by 150 basis points on a 10-year asset. It implies that the price is going to drop a certain amount for a 150 basis point move. That's just the way it works. Yep. But the bond market, for example, if you look at the short end of the curve, 272 year is pricing in those anticipated 7 moves by the Federal Reserve. And do they end up doing 10 moves? If they do, maybe that rate needs to be higher. But at this point, it's pricing in the 7 that Federal Reserve Chairman Powell has said to the market, we are going to do 7 moves of 25 basis points.
So Chris, I guess want to make a point about bond and interest rates too, right? So what you just described here is, hey, over the next 2 years, right, with the Fed Powell and the Fed Reserve raises that short-term interest rate, that eventually that's pricing in that the bond market believes that those rate increases are going to happen to get the rate up to 2.7. So that's why it's already priced there, right? Even though they've not done that yet.
That's correct.
Right. So the market, is this in the Fed doing this? The market, when we look at what do we think interest rates are going to be over the next 2 years to compensate people for what will happen. So the market then reacts and makes that interest rate what they believe the average rate will be over that time frame. So elongate this now, right? So we've been talking about inflation a lot, and we've thrown out like a 7 or 8% inflation number. So if inflation was going to be more permanent, this is just in my mind how I'm thinking about it. If inflation was going to be sticking around over the next 10 years, you just described an interest rate of 3% for the 10-year, right? That it went from 1.5 to 3, not 1.5 to 7, not 1.5 to 9. 1.5 to 3. So what does that kind of say to you about what the bond market's thinking about where inflation is going to be over the 10 years?
Well, that the bond market is the best predictor of where inflation will settle in over the long term in a normal environment. I don't know if we have the time or to go into the Federal Reserve balance sheet that has put interest rates, long-term interest rates, at an artificially low rate over time. But in normal times, independent of that Federal Reserve action of buying bonds, the bond market is the best predictor of where long-term inflation will settle in. And so if you look at it that way and ignore the balance sheet factor, it would be saying that 3% is a 3% 10-year is implying that inflation would be somewhere probably in the 2.25% long term.
So, and to get to that point, that would be assuming it's, again, outside of the Fed buying bonds and causing pressure in interest rates to go down. But say that 3% level, well, you get compensated for holding your money longer, right? So the longer I go out, so I get some level of maturity risk and holding on to debt for longer. So that plus inflation plus again, depending on what the issue is, if it's not a treasury, maybe credit risk on top of it, all of that leads to that rate, right? That 3% rate that's happening there. So I think that's an important point is, say the Fed is kind of keeping rates a little bit lower, maybe by 1%, right? Maybe there's additional on top of that if they weren't holding any of these other bonds and another bond buyer in the market. But I guess my larger point is that the bond market today is really not saying in total that inflation is a structural resident, I guess, in interest rates here going forward over the long term.
Absolutely. Yes.
Right.
Then the 10-year would be trading at 9%.
Right. So I guess that's my larger point here when we've been receiving these questions from people like, oh my goodness, inflation, we got to do all this today. We got to be more aggressive with our investments because I need to earn 10% because inflation's eventually going to be 8 and 9. And I got to earn more than I'm going to have for cost to keep up over my entire retirement. And I guess what we're saying here is what we're seeing in prices today says that really that isn't so, that we don't need to change our investment strategy because of what we're seeing maybe in more temporary terms from inflation numbers today. Would you agree with that?
Absolutely. Yeah. I think I was going to bring this up earlier, and during the initial stages of inflation rearing its head over the last year and a half, the question kept being asked, is this sustained inflation? Is this sustained inflation? But nobody was really saying, well, what's the definition of sustained inflation? Are we talking, is it going to be around for 2 years? Is it going to be around for 6 months? What is short term? For those that were saying, Janet Yellen was saying, I think it's temporary. The supply chain issues will go through. But even she wasn't saying in 6 months, or maybe she did comment on some time frame. But to your point, we're dealing with an inflation issue that is addressable by the Fed, and it's a temporary, right? When we look over a 100-year span, it might be a little blip in terms of time. The level of inflation that we're witnessing today of 7.5% there's really little to no chance of it being sustained over a long period of time. And I'll define that to say, beyond a year, but forget about being a 10-year, 5-year problem. No way. Not
so Chris, I think this is a good time to rotate into, again, there's a lot of people in 2022, January 1st, maybe even going back to October, November of 21 till today. And I'll kind of clarify today as being, say, end of April, early May here in 2022. So a lot of what we've heard is, hey, inflation has impacted lots of things, maybe from stocks with recession risk, but also interest rates are going up. So a lot of bond investors have lost money. So you get stocks have lost money in 2022. You've had bond investors lose money here in 2022. It feels like we're losing both ways. And I think that's where it's a little alarming, I think, from an investor perspective, because in other environments, we've typically seen, if like in the 2020 pandemic, when stocks went way down, everybody went to the more risk-averse investment, and we went towards bonds. So bonds actually went up in price, and investors made money in bonds while as a generality in that time period when they had lost money in stocks. So you see kind of a counterbalancing that's happening. So I guess my question here is, it's easy for a lot of clients or any investor out there to look at this and go, well, geez, if inflation's this now and interest rates went up and the interest rates go from 3 to 4, 4 to 5, 5 to 6, 6 to 7, 7 to 8, 7, 8 to 9. Oh boy, man, I just lost a lot of money just with the 10-year treasury going from 1.5 to 3. What would it be if I went from 3 to 9 here? And I think that's where a lot of people start really getting very concerned, very fearful, very upset. So when we've had rising rates over time, so I want to ask you about what have you seen happen in stock and bond returns over time during those time periods?
Yeah, well, you look at this space and time from 1930s to 2010, and you have a great example of where over the sustained time period there was a shift in interest rates that occurred, as you can see, from the 30s to the 80s of 3% to 10% for the average 10-year yield. Yet over that time period, you had positive bond returns and positive equity returns. And it is not, yes, within that time frame, there would be shorter segments that would have negative bond returns, but over a sustained time, the cash flows coming off of bonds generated a positive return. And that's important for people to look at, despite the fact that interest rates went from 3 to 10.5, I think is the peak that it shows on this particular graph or table.
And just so for the people that are listening on the audio version here, so we actually brought up a blog from it's a wealthofcommonsense.com. It's a Rit Holtz Wealth Management does it's a really great blog here, and we wanted to show this table. So we'll have a link to it in our show notes as well. But I think a lot of that, I think, Chris, what you're pointing out is that from a bond side is that obviously price is moving, right? So that's part of it is what, you're seeing interest rates move and our bond prices move with interest rates on a daily basis. But because coupons, maybe for a lot of bonds, happen on a semi-annual basis, you don't actually get this kind of big income payment until maybe even 6 months later after that move happened, maybe at the very worst, right? So you get half of that coupon 6 months later than the other half 1 year from it, right? So it might take a while for you to kind of get that income to offset some price change if interest rates are going up. But I think your point is, obviously with bonds, they're repricing their interest rates as well. If interest rates are going up, then over time you are getting a higher coupon. So you're getting higher income payments as they go as well.
Right.
So, but I wanted to give this, I think it's important that you kind of gave us this context here, because I think it's easy to look at this and go, hey, we've just experienced the last 4 months or 5 or 6 months losses on stocks and bonds when inflations have been there. And to your point about, hey, we need to look longer term, and just because we're seeing something in the moment, even a year or two, may be completely different than what we've experienced here so far in the first few months of 22, right?
Right.
Okay. So again, we'll put that linked in the show notes to this table for you guys to check out. But I think the important part is, by decade, again, longer term investors, you have been rewarded by continuing to stay invested in stocks and bonds, even in spite of inflation, even in spite of rising rates. And I think that's the important piece to know, because I think there's a lot of fear out there that we've been hearing from our clients and prospective clients. Well, just go to cash. Don't take the losses in the near term. And isn't that better than losing money on a daily basis forever in bonds? So, Chris, I guess what would be your counsel to the people that are just saying, time to go to cash, time to get out, just get out of the whole thing and just lock in what I have?
Yeah. Cash is not going to get you there in terms of your long-term targeted returns, and trying to time the market of getting out today to then get back in at some point is also not going to get you there. It's too difficult. So I think that remaining invested, and you can target certain instruments that would be more favorable on the unknown interest rate environment that we might be looking at. Staying shorter in duration, for example, like the yield curve is it's not a curve, it's a line today, right? We're basically at 271, 2 years out to 3%, 30-year. That is not much of a curve. And so if you can earn that 2 3/4 type of yield on a 2-year asset, versus taking the price risk of a longer instrument earning the same 3%, 2 3/4, then you'd be better off on the shorter duration. And that's something we're recommending, for example, but not cash, right?
Yeah.
The 2 3/4 on the 2 year is already pricing in the Fed moves that we have, and cash is at zero still, or effectively zero.
Right. Yeah, no, that's great. So we've kind of reached the end of the conversation, Chris. I do have one more question for you, not inflation related, I promise. Well, it might be a little bit.
Maybe it is.
Yeah, you never know.
Maybe it is.
So obviously the name of our show here is Retirement Success in Maine Podcast. I know you're not directly located in Maine here, but I still want to ask you, how do you plan to find your own personal retirement success when you get there?
Personal success in retirement. I think, one thing that we always talk to our clients about, that we can't control the returns on the markets on our assets for sure. And having a good understanding of the money that I'll need to live a comfortable lifestyle in retirement is finding that number, finding the tolerance level around that, so that I can go and do the things in retirement that I want to do, all within the parameters of what it is that I can spend. And I think that that's so important, because then you can just comfortably live in retirement.
That's great.
Well, Chris, thanks for that answer, and I appreciate you coming on. Obviously, folks that have listened to our show, they've kind of seen you a little bit through our roundtables and our discussion on kind of where things are, but very specifically into inflation. Really appreciate you coming on, really educating everybody about kind of some of the levers that are at play, where we are today, and kind of some things that we could be doing to kind of keep up with where things are with our keeping our retirement to last. So thanks for coming on. We really appreciate it, and we'll catch you next time.
Well, thank you very much for having me. As you can probably tell, I love talking about this stuff. So if anyone wants to follow up on the discussions like this and what the Fed has to do, it's very enjoyable to me. So thanks for having me.
All right. Appreciate it, Chris. So I know everybody's been introduced to Chris in some previous segments, but good to have him be a dedicated guest today for the first time. Again, he's such a really great resource for our entire team, especially around his knowledge around fixed income. So hopefully we're able to kind of convey that to you, and his expertise and how he really informs a lot of our thinking at Guidance Point Advisors and our knowledge on fixed income. But one thing I want to point you to is we will have, obviously we talked a little bit about a chart and some returns in stocks and bonds over time. We want to source those things, of course, and make sure that you can see that. So if you go to our website, if you go to blog.guidancepointllc.com/64, because we're episode 64.
That's right.
You can check out that link there. We're going to have a little bit of Chris's contact there if you want to reach directly out to Chris. So that you can find as well. I want to tease, we have a really awesome episode and a guest coming up on episode 65. I kind of said in the intro, we're going to talk Medicare, right? So Medicare, and we're become eligible at 65. Well, our episode 65, so it's good time to kind of put that together. So that was our long plan on episode 1, as we got to wait for 65 episodes to get to Medicare.
We actually recorded it 3 years ago, and we just been waiting.
Yeah, exactly.
For this,
You're right. Yes. So we have a really great guest coming on, Jamie Alexiev, that will do a great job walking us through that. So look for episode 65. But appreciate everybody tuning in. Catch us. You can catch us on YouTube, and of course the additional audio links too. But appreciate everybody's viewership and listenership, and catch you next time.